Now that I've gone over the fee structure, you can see how it's very lucrative. And at the time of doing this video, the top 25 hedge fund managers in the U.S. Were billionaires. So you don't have the same results from mutual fund managers because you don't have that upside potential that you do on that payout structure. Okay, so now let me go over some of the good and the bad of a hedge fund. So what are the good points? One is the manager usually invests money. Okay, so you could say, well, that could be a decent check because they're not going to want to blow their own money. Okay, so there's some benefit there, and the second is you get professional management. Now you could argue that you could get that anyways with the mutual fund, but that is still better than doing it on your own, or that's the implication. Now, what are the bad points of a hedge fund? There's the implied risk from the fee structure, which is much different than a mutual fund. Secondly, you could say that it's actually very expensive because of the fee structure. And that's evidenced by the fact that the number of billionaires. Third, it's riskier because of the ability to have shorts and derivatives. So again, as I said, if those were used to hedge your risk, that's fine. But if they're used for speculation, then it's clearly going to make it riskier. And the fourth is, there's less regulation in general, because the impact of this is, or the assumption of this is that these are sophisticated investors, so you don't have to have it regulated as well. Okay, so are they risky or not? It would really depend on a whole bunch of things. I would say probably the biggest thing is you would want to look at the risk of the manager. So first of all, how much of their own money do they have invested? If they have a lot, that's probably a good sign. If they have 5%, that's not a lot. Secondly, you also want to look at the history, the performance, and the nature of risk that manager takes. Okay, so those would be good indicators. And one common statement that I hear that can be somewhat misleading is the fact that the average hedge fund results are greater than the market. Greater than market results. Sometimes you hear it quoted as greater than mutual fund results, whatever. Now that's a generic statement, and there is some element of truth to that. If you take all of the existing hedge funds today and you run a long-term performance history, they do tend to have good returns. What's the problem with that? The problem is something called survivorship bias. And what I mean by that is you are taking a history of the returns of all of the funds for the last 20 years that have been around and have survived. You are not including in your results all of the funds over the last 20 years that started and went bankrupt, which would mean they probably had 100% loss or maybe a 50% loss, and then they just liquidated their assets. So as a result, these results are really, that statement is very skewed. Nobody really has at least I haven't seen a detailed study that would include every hedge fund that started and liquidated and included their returns. That would be more comprehensive. It would just be very difficult to do a study like that because of the sheer number of funds that came in and out, and the fact that a lot of these don't have the regulations and filings that mutual funds do. Okay, so that's a general overview. If I had to make a conclusion, I mean, I don't think you can necessarily say as a general rule that hedge funds are bad or good. Each specific one is going to be very different. And you just have to go through each of the individual factors that we talked about: the payout structure, the risk propensity of the manager, and how much of their own money they put into it.